DocuSign stock has had an excellent year in 2024, rising significantly from the start of the year. Of course, I'm happy about that. I've had DocuSign stock rated as a buy for a couple of years now. But DocuSign stock is still down significantly off its all-time highs, and investors are wondering what's a fair price to pay for this stock. That's what I'm going to answer in this video. I'm going to do a discounted cash flow valuation of DocuSign stock and answer what I feel is a fair price to pay for this e-signature company. So let's get started. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So 3 of the inputs I'm going to need for my model to predict or answer what the intrinsic value per share is are the market cap, which stands at $19.84 billion, cash and equivalents balance at $611 million, and the total long-term debt, which DocuSign has 0 debt. That means the balance sheet is in pristine condition, hundreds of millions in cash with 0 debt. I also need the number of shares outstanding, which are 208.71 million. Moving on, I need the Wall Street estimates for DocuSign and what their cash flow from operations or what their free cash flow will be between 2025 and 2029. Their fiscal year for 2024 has already been completed, and the company delivered $890 million in the fiscal year that ended January 31st, 2024. For the year ending in 2025, the analysts predict a small decline to $850 million before rising to $980 million in 2026, rising to $1.08 billion in 2027, to $1.23 billion in 2028, and $1.31 billion in 2029. The factors that will drive this increase are pretty simple to understand. Electronic signatures offer massive convenience advantages to both sides of the equation, both for the party that's signing the documents, and for the party that wants the documents signed. Usually this means enterprises are the ones that want documents signed by consumers who are the ones signing the documents. If you understand how these situations work, you'll understand that enterprises oftentimes miss sales because the signing party does not want to come and sign the document when they have to do it in person. There's friction there. It's inconvenient. People have to find transportation. They have to find parking. They have to travel to where the offices are. Maybe the offices are far away, and so the documents need to be shipped by FedEx. That could take a day or more, and then they need to be signed and sent back. There's friction, right? There's no reason for that to exist when you have the ability to sign documents electronically. So much more convenient, so much more cost effective. It's a no-brainer for 95% of the situations that need signatures. For the other 5%, I don't think they will ever move to electronic document signing. But that's okay. DocuSign doesn't need the entire market to become electronic in order for the company to benefit and increase. As you can see here from these forecasts, the analysts on Wall Street are not forecasting explosive growth here. They're forecasting the free cash flow to grow from $890 million in 2024 to $1.31 billion in 2029. This isn't explosive growth here. This is steady, solid growth for DocuSign, given that the industry is not that large. It's not growing all that quickly. I hear a lot of arguments about the competition can come in and take market share away from DocuSign. That's true. That's very true. But up until this point, large companies, they're not very interested in this relatively small market. They don't want to spend the resources to try and capture market share in this category when the upside is not that big. And so they leave it to companies like DocuSign. And, there are competitors already in the space, notably Adobe and DocuSign, with DocuSign having the largest market share. I also need the company's beta, which according to Yahoo Finance, it stands at 0.9. And now that we have all the inputs, I can share with you my valuation model for DocuSign stock, starting with the $890 million that was for 2024, rising to $1.31 billion for 2029. From 2030 to 2034, I'm forecasting the company's free cash flow will grow at a modest 8.1% growth rate, which is the same growth rate that the Wall Street analysts are forecasting for these first 5 years. So I have the growth rate remaining at 8.1% for the next 5 years as well, before settling down to a longer-term growth rate of 5% starting in 2035. So because these are cash flows expected in the future, we need to discount them back to today. That's the numbers you see below the forecasted free cash flows. This is the discounted number. And the discount rate I'm using for DocuSign is a weighted average cost of capital of 9.5%, applying a cost of debt of 7.5% with a capital asset pricing model, cost of equity of 9.6%, applying a beta of 0.9, a risk-free rate of 4.2%, and a market risk premium of 6%. The market cap for DocuSign is $19.84 billion, and the company has zero debt. So I'm giving them a target capital structure of 5% debt and 95% equity, as I do with many of these companies that have zero debt, because I assume they will want to take on some debt eventually, because the cost of debt is always, well, not always, but most of the time, lower than the cost of equity. So when I discount those cash flows back to present times, present day, the value of its operations are $26.3452 billion. But we're not done yet. We need to add the company's cash balance to that total, which brings the value of equity up to $26.956 billion. And that's the value of equity of the business. But we want to know, what's the price per share? What's a fair price per share to pay for DocuSign stock? And to find that, we need to divide the value of equity with the number of shares outstanding, which brings me to the intrinsic value per share of $129.16. And that's compared to DocuSign's current market price at $98.17. So despite the significant increase in share price for DocuSign in 2024, I still find that the shares are undervalued when calculating them using my discounted cash flow valuation model with the inputs that I shared with you in this video. Now, one of the reasons why the price is so undervalued is because the company's beta is very low at 0.9. So I wanted to look at a scenario where the beta rises to 1.25. And in that scenario, the share price would be worth $88.69. So the beta would have to go up significantly for the shares to not be undervalued. Even in this case, $88 compared to $98, it wouldn't significantly be overvalued, even if the beta were to rise by that magnitude, which I don't foresee happening given the characteristics about the company I shared with you throughout this video. Now, this doesn't mean that the market price will ever reach my intrinsic value per share. This is just what I feel would be a fair price to pay for DocuSign stock. And if you can get it for less than that, then you're getting a good value with DocuSign stock. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.